This has been a recession of opportunity thus far. The people know, even if the data doesn't show it, that there's a lack of opportunity in especially the US labor market. It's very difficult to find a job, assuming that you can find one anyway. So, as the US economy exhibits more and more signs of this recession of opportunity, it spills over into the mainstream. And only certain statistics are picking up on this. One of them is the unemployment rate, which is beginning to rise enough that people are beginning to notice. Another one that we keep talking about here on my channel all the time, especially when we get Mr. Steve Van Metre on, jobless claims, in particular continued jobless claims. What that shows is exactly what I just said, a lack of opportunity. If you are one of the thankfully few who are laid off, it means that you're stuck on unemployment insurance and getting unemployment insurance aid because you can't find, at least not immediately, another opportunity. But as that lack of opportunity continues to grow and build through the economy, it leads us in the direction of the more familiar recession vibes that we normally get. It leads to recession data as well as recognition in the form of the Fed's rate cuts. There will be rate cuts coming, and even Federal Reserve officials are starting to take note of what's happening over here with this lack of opportunity in the labor market. So, Steve Van Metre, you're here. Let's talk about jobless claims because it's quite an eventful week that we just went through, but jobless claims still is one that stands out, especially continued claims rising as much as they have.
Yeah, absolutely, Jeff. And as you know, I know there's a lot of data that comes out every week, but there's only one thing I really care about right now, and that's the labor market data in the initial claims and continued claims. And of course, we saw initial claims rise by 20,000 on a seasonally adjusted basis, and that was quickly dismissed as some one-off event. And then we saw continued claims, which rose by, we'll just say, a modest 20,000 to 1.867 million. And on the front of this, it's like, that's not really a big deal, but it's the non-seasonally adjusted claims that really was a shocker to me, up 157,950, now at 1.953 million. And this is interesting, Jeff, because when we look at demand from the economy, people that initially lose their job, they'll actually go out and spend some money. Sometimes they take some time off. They have projects, hey, I've been meaning to clean out the garage, and no problem, I'll get another job. But the issue is the longer you stay on unemployment week after week, well, your savings goes down, perhaps your severance runs out, and the next thing you know, your spending drops off a cliff. And particularly now, we see increase in insurance rates. We know energy prices are up, and we're here in the summer, gasoline prices are higher. And you start looking at these factors of debt service costs, and next thing you know, there's a reason why continued unemployment claims start to spiral out of control. It's slow at first and then seemingly all at once, because as my demand goes away, if I've lost my job and been on unemployment for say several weeks or more, well, that transmits into less discretionary spending and other people losing their job. And of course, when they lose their job, there's no job market for them either. And then it just starts to snowball.
That's the thing though, right, Steve, is, continued claims, they've been moving higher for 10, 11, 12 weeks here. They moved higher last year a little bit. The slope that they're going up, the acceleration, the deterioration in the marketplace, the labor marketplace that we see in continued claims, this seems like something has changed, something specific and something substantial has changed over the last several months. And as you're saying here, it's noteworthy because the last several months, this is summertime when things are supposed to be really picking up. And as you just mentioned, employers are looking at their costs. They're looking at their revenues, the slowdown that we saw earlier, really going back to last year. Now costs are up, as mentioned, energy, insurance costs are up. So it kind of makes sense that all of these negative factors and signals are starting to really converge on one another. And the continued claims, which represents the lack of opportunity in the job market, I mean, employers are saying, okay, whatever's going to happen in the economy, maybe I'm happy. Maybe I think Jay Powell and his rate cuts are going to help. But right now, I just got to get by. So I'm not going to hire anybody. I can't hire anybody. My costs are going up. Revenues are weak. I'm just going to try to hang in here until Jay Powell starts cutting rates, because everybody and everything I hear says rate cuts are going to help me. And so what we're seeing in continued claims is, especially the surge in the continued claims and the continued surge in claims, is that we're getting to that point where more and more are reaching that same situation, which means the initial stage of that vicious cycle looks like it might actually be here.
Yeah, and what's interesting, Jeff, is we've heard from these small business surveys that one of their issues, aside from inflation, is the lack of qualified labor. Well, arguably, we could say there is qualified labor moving on to the unemployment line, but the question is, why are they staying there? So on one hand, you're hearing business owners say, hey, I can't find people. The problem is then they look at the current business and they're looking probably at their pipeline of business down the road and saying, gosh, man, I would really like to go hire someone who's qualified. I just can't afford them and I don't see the opportunity. And so they complain about it, but they do nothing about it. And that's interesting to me, as it's just a sign that the broad economy here is slowing down. And as you said, this is a summertime. We're supposed to see people out traveling and spending money. And yet here in Orlando in particular, Jeff, I find this very interesting that restaurants, I know a lot of people in the service industry, and they say it's slow, and it shouldn't be slow. Even the theme parks are running at slower levels than normal. Everywhere you look around, you say, where is all the tourists? Well, it's a simple fact. They don't have the money and they're staying. Are they traveling? Yes, but they're staying likely close to home. And that's not putting out all the money in the economy that we really need to see at this time. Because you also think about businesses at this point. A lot of small businesses do a lion's share of their business during the summer months to get through the winter months. Well, if you have a bad summer, it's not going to look good when you get to the winter.
Yeah, it isn't just us who are asking, where is everyone, or the tourist industry in Orlando. Even Federal Reserve officials are starting to ask that question too. They've been focused like a laser on CPIs because they've been embarrassed for so long, especially the sticky CPIs this year, which suddenly disappeared. So they've been focused on that side of their dual mandate, but more and more you're hearing them talk about their focus is shifting to exactly what we just said. The lack of opportunity in the labor market has gotten to the point where it's actually reaching the official level. Just, I think it was yesterday, a couple of days ago, Chicago Fed President Goolsbee, he talked about what did they call it? The golden area, the golden path. Goolsbee said that the labor market is definitely an area of concern. Those were his words. And when he was asked whether or not the Fed was risking the golden path, as Goolsbee calls it, he said the prospect of winning their inflation battle without a significant rise in unemployment is actually falling. When asked about the Fed risking the golden path, he said, yeah, they are. Which means that in two things. Number one, the Federal Reserve is going to start cutting rates. We know that's going to happen. But number two, it also means that the weakness in the economy, especially in the employment part of it, has gotten to be such a big issue that even Federal Reserve officials who would still rather be talking about restrictive policies and consumer prices are now starting to think, well, we might need to really accelerate this process to rate cuts, because if we don't, we know what happens here. We get to the recession. That's another thing we keep hearing from even just mainstream commentary. That's okay. It's getting this soft landing. Sure, maybe we're going to have a little bit of a slowdown, but now we're starting to see more signs that this has gone beyond a soft landing. And as the Fed moves toward its rate cuts, that's just acknowledgement of that fact.
Yeah, Jeff, and everyone believes that, hey, if the Fed just cuts, say, once or twice, they're just going to release all this pent-up demand in the economy because for some reason a quarter point in the federal funds rate is having an issue with people spending money. And of course, we know that's not the case at all. But the issue, we talk about the labor market here. By all the data we know and from what all the Fed speakers are saying, it's unlikely we're going to see a cut at the end of this month. Now, if the Fed does cut, then what's going to tell the markets is the Fed knows something that we can't see, and there's a big problem. But then you fast forward, the next time the Fed gets together is September. And if the continued claims, if we look at and people stay on continued claims and that continues to ramp into September, well, what's going to be the same situation we see time and time again with the Fed is they're behind the curve. And this is assuming the Fed rate cuts actually do something. And I'm kind of making a joke here. Of course, we know they don't, but there's a whole notion that somehow magically the Fed can stay on this perfect glide path and they just need to make some small adjustments and it goes well. The issue now is we're going to have a gap between policy meetings, and even if the Fed cuts could do something, by the time they get to their next meeting, it is going to be too late. And then, of course, as we know, it's not one cut or two cuts. It's going to be a series of massive cuts.
Yeah, that's the thing. Once the rate cuts start, we were talking about this before we started here, that the Fed boxed themselves in to a rate cut path. Because they are not effective, because they don't work, they react to the rate cuts in the same way they kept reacting to consumer price numbers, right? So as the CPIs continue to be sticky and whatever else, the Fed kept saying, well, we got to hike more. We got to hike more. We got to keep it more restrictive. Same thing is going to happen on the downside with the economy as the unemployment rate rises. As the unemployment rate rises too much, the Fed says, okay, we got to cut rates to do something about the unemployment rate. But cutting rates doesn't do anything. So the unemployment rate rises again, which means the Fed has to cut rates in response to that weakness. It doesn't work. So there's more unemployment and the Fed cuts rates again. So there isn't one cut or two. As long as the unemployment rate rises, the Fed is going to have to keep continuing to cut rates because it doesn't work. But yet they tell everybody that it does. So they box themselves into the situation where they are now slave to the unemployment rate in the same way they have been a slave to the CPI. And if the unemployment problem continues to go for a prolonged period of time, which, by the way, historically speaking, that's what happens whenever we get to these cycles. As soon as unemployment makes a certain move, which we've already probably met, it's going to continue for quite a period of time, which means that as that period progresses and the unemployment rate continues to go up, the federal funds target rate by definition is going to continue to go down. Each and every rise in the unemployment rate will be met by another cut in the federal funds target.
And the thing I've made a case of, Jeff, is the funds rate's headed back to zero. Now, historically, we could look back and say, okay, they always lower it, below the lowest level of the prior cycle. The problem is now we've been at zero twice. So we know they can't go past that. So they're going to go to zero fairly quickly. It'd probably be the fastest move to zero. Of course, we had the fastest increase by Powell. We're going to have the fastest decrease because he's going to try to run and tell people, look, I can save the world again by just dropping the federal funds rate, which will help the banks a little bit with their asset portfolios. The problem then is when it doesn't work, because it doesn't work and it won't work, then you're going to watch the Fed vacuum up literally the global market on U.S. Treasury securities. And I don't think that's a really good move because they think it still works. They think quantitative easing is a wonderful thing. As you and I know, it pulls critical collateral out of the banking system at a time when the small and mid-sized regional banks are already hemorrhaging and still have a large amount of money they owe from the bank term funding program. Of course, who knows how that's going to get paid back, but you can literally start to see this thing as the labor market unwinds.
Well, you just mentioned something. I mean, the reason why, let's face it, rate cuts are all about superstition. Everybody believes it because that's what everybody says. So it's basically a superstition. But it's a superstition because it sounds plausible on its face, right? As you just said, you pointed out one of the facets of the superstition is the Fed reduces interest rates at the short end, which should in theory make it more profitable for banks to borrow, right? Their profits go up because their net interest margin goes up. And while in theory that might be the case, in practice, okay, the federal funds rate goes down, short-term money rates goes down, and banks can say, if I would make a loan, I'll make more money. But that's during a time when banks don't want to make any loans. It doesn't matter what the federal funds rate is. They're going to look at the unemployment in the United States economy and say, do I want to lend to consumers here? Businesses are struggling. Do I want to lend to businesses here? It won't matter what the federal funds rate is because the banking system is, I'm too risk averse. Everything in finance runs on risk adjusted returns. And so when the perceived risk goes way up, it doesn't matter if the federal funds rate gets cut a little bit at the front end or even a lot at the front end. The perceived risk makes it unappetizing to get involved in the credit creation in any type of loan making. So even the stuff that is supposed to be the basis for the superstition, when you stop and think about it, it doesn't make any sense. In fact, it actually makes sense in the context of these historical failures. We keep seeing this time and time again, where rate cuts don't do anything. Banks are not going to extend credit during a recession. They're going to be cutting it back.
Jeff, I'm trying not to laugh here because this is so funny because it's literally like watching the same TV show play out again. And we're sort of saying, this is going to happen. And everyone's like, no way. But you have to think about it from the bank's perspective. When you lend somebody money, what is the one thing you care about? it's getting your money back. And so when do you not lend to people? Because a lot of people think, well, the banks can still lend during a recession. Well, of course they can. But if people are losing their job and businesses are failing, the probability of you getting your money back, well, is not there. And in a low interest rate environment, you're not making enough money on the interest rate spread to cover a large loss and risk. Now, in a high interest rate market, you can take some more risk because you have money flow here. But the reason I'm laughing isn't about that, Jeff. It's because of bank stress tests that were put on by the Fed. And they said that we believe the banks will have the capacity and ability to lend during a recession. And as I read that, I was like literally trying not to laugh because that's the whole beauty of the Fed. They think, hey, if you have enough collateral, you'll lend. It's like, no, that's not the issue. And the banks are not going to lend anyways. And guess what? People aren't going to be able to borrow because what are they going to do and go to the bank and say, hey, by the way, bank, I've been on unemployment for 6 weeks. Could you loan me some money? And the answer is they're going to say, no, but we'd like to foreclose on your assets while you're here. And so we look at what's going on and we can see exactly how this is playing out. And you're right. A Fed rate cut won't make any difference. It would only matter potentially if the intermediate and long end of the curve stayed elevated so the yield curve would normalize. But as you and I know, Jeff, if the Fed cuts rates across the curve are coming down.
Yeah, and that's, I think, the point that we're making here is that we continue to see, as we keep talking, and we've been talking about this for months, more and more the evidence continues to move in the same direction. We've gotten to the point where, this lack of opportunity in the economy has become so visible and so clear that even Federal Reserve officials are talking about, okay, we might need to do something here. And as they get to that point, that just means that once it starts, that it's already gone past the point of no return. When you look back through history of the business cycle and the Fed's rate cuts during those cycles, by the time they start cutting, it's already too late to begin with. And the rate cuts that they do in the initial stages, as aggressive as some of them are, I think in 2008 and 2001. In 2001, I just went over this in my previous video. Alan Greenspan's Fed cut rates by 50 basis points, 5 straight meetings. 5 straight meetings, 50 basis points, and the unemployment rate surge after the rate cuts were over. So the Fed is going to cut rates. They're going to have to cut in a series of rate cuts because rate cuts don't work, and they're going to chase the unemployment rate higher and higher, and interest rates go lower and lower. And then the question is what it means after all of that, after we get done, and how long this actually goes on. But as far as getting into that situation, the initial stages of moving toward that full-blown recession, not just no longer just the recession of opportunity that we've been dealing with for the last really 6 months, 7 months, 8 months, whatever it's been, moving into the full-blown recession where we can see unemployment and rate cuts are piling in. What does that mean from there?
Well, Jeff, I can tell you what it means. Investors are making the same mistake they do at every peak of every cycle. Everyone believes a few cuts of the funds rate is going to be bullish for stocks, but you can look there. It's just like the Fed's track record is, 100% failure. There's no Fed rate cutting cycle that doesn't end in a bear market in stocks. And yet, what are people doing right now? They're buying into the weak. We just seen the market come off, as highs for a few days. People are buying here because they think there's a Fed rate cut coming. Be careful what you wish for. Historically, it's not what you want.
I'm going to be like the Fed. I'm just kind of pick one and just gently glide right into the soft landing of this video.
That should be your ending. I didn't have an ending.
Yeah.
I'm just going to gently glide into one and hope it works.
Gently glide into the soft landing of this YouTube video.